There is a major warning sign that we need to start paying attention to on the U.S. housing market that signals that a home price crash is going to be coming next. And for a lot of places, we've already seen a home price crash, okay? Like half of the metros in the country are seeing year over year home price declines, but those price declines are going to start accelerating because of one big reason, and that is days on the market. And I want to thank Tony for sending this story over to me, because right now, out of 44 of the 50 largest metros in the United States, the homes are sitting on the market way too long. And funny enough, the hardest hit area for this in the entire United States is Miami, my hometown. But across the country, the typical home is spending 60 days on the market right now as of August, which is 7 days longer than a year ago, and it is now above pre-pandemic norms according to Realtor.com. Buyers can't afford today's prices. Mortgage rates remain elevated between 6 and 6.5%, even though that's historically normal. There's been a massive financial downturn in our economy in terms of people being able to actually keep up with today's cost of living. And at the same time, the supply has been building in the background, and there has been a steady stream of new construction that is pulling demand away from the existing homes. So most sellers are responding by either cutting their prices or pulling their listings off the market altogether, hoping to kind of wait it out, which is kind of a stupid plan, because there ain't going to be no waiting this out unless you have an extra 10 years to wait it out. Let's take a look at some of these numbers. In Miami, homes are taking up to 90 days to sell, up from 74 days last year. Orlando, homes are sitting on the market for about 77 days, up from 63 days a year ago. Tampa is at 77 days. Jacksonville's at 74 days. Austin, Texas is at 72 days. And you can see a lot of these places are in Florida. Not really a big surprise either, considering Florida is ground zero for the housing crash. And it's going to be interesting when I get back to Florida to see what's going on, boots on the ground over there, and see some of the ridiculous listings and the prices and the price cuts. I'm sure there's going to be a lot of stuff to see with that. And Miami right now is ground zero for home sellers taking their properties off the market in hopes for a better market next spring or whatever. And I have seen this so many times over there. They continue playing the same games and always somehow think that this time's going to be different, when in reality, this time is just worse. That's how it's different. Because at least in the past, when they did this, home prices were going up. Now they're pulling properties off the market in hopes to sell it for a better deal next year, while home prices in Miami are going down. So when they go to relist next year, if they don't relist at a lower price than what they're trying to sell it for now, they're just going to be wasting their time and their real estate agent's time. In fact, Miami saw 57 delistings compared to the 100 new listings that came out in July. So every time there's 100 new listings hitting the market, you have 57 sellers pulling their homes off the market. Nashville, Tennessee, however, is seeing the largest year-over-year increase in the time spent on the market, because Nashville homes are sitting on the market about 59 days right now, which is 21 days more than August of 2024, when it was only 38 days on the market. In Las Vegas, homes are sitting on the market for 56 days compared to 42 days a year ago. And we know that Las Vegas is a city that has been struggling tremendously right now, with tourism numbers down by a lot, now that Las Vegas is no longer a cheap, fun place to go. In fact, Las Vegas has seen their housing supply rise 31% year over year, which is the biggest increase of any major U.S. metro area, and it's approximately triple the national increase according to Redfin. So we are literally seeing a 2008 repeat right here when it comes to where the inventory is building the most and the fastest, where the prices are already coming down the most and the fastest right now. It is basically a mirror image of 2008. We saw this in Las Vegas back then. We saw this in Miami and throughout the rest of these Florida cities back then. Like, this is how it goes every single time. It's almost predictable. And these price reductions are really starting to show, because in Tampa, prices are down 6.2% from a year ago. Austin, Texas, prices are down 6%. Miami's down 4.6%. Orlando's down 4.3%. and Dallas, Texas is down 3.9%. All areas where days on the market is rising, inventory is rising, and price cuts are surging. So really any market where the price corrections are the steepest right now are the markets where we saw the largest amount of inventory increase compared to before the pandemic, which shouldn't come as a surprise. Realtor.com is expecting only 4 million transactions this year, which would definitely be lower than last year and will be a new all-time low for the past 30 years, going back to the early 1990s. Like literally the last 3 years in a row, if you count this year, have been the worst year in 30 years for housing sales, guys. What does that tell you about the current state of affairs with real estate? Even the economists at Realtor.com are stunned by this. Danielle Hale, she says that even with more homes on the market, buyer response has remained muted compared to what we'd expect from similar supply shifts in the past. Yeah, people want to say this time is different. It is different this time. People are completely tapped out, they're broke, and fed up with today's housing market. Nobody wants to pay these prices. Nobody's willing to say that your house is worth what you're asking for right now, in general. It's not like it's like that everywhere, but that seems to be the trend. If you're like me, you are probably sick and tired of all of these different companies cold calling you and sending you these random text messages and always getting those spam emails, things like that. And that's all because of data brokers. And that's why today's video is sponsored by Delete Me. Delete Me is a hands-free subscription service that will remove your personal information that's being sold online. And Delete Me's privacy experts remove you from hundreds of data brokers all year long. There's just so many websites out there with all of your information. Just take a look at these data brokers that have my own personal info here, my own personal example. And I've never heard of any of these companies. But Delete Me removes as many of those listings as possible on your behalf. They'll remove things like your name, your address, your marital status, your relatives info, your court records, your driving records. So make sure to get 20% off your Delete Me subscription today by using the link down in the description below at joindeleteme.com/board and arrow or use the QR code on the screen. Now, something else I've talked about pretty extensively on the channel in the past has been how people have been using home equity loans and home equity lines of credit to get by right now and borrow against their house in order to basically make ends meet. That's a pretty popular way for people to extract value out of their home if they have a significant amount of equity and don't worry about it and just have an extra payment. But there is actually another way that you can extract equity from your home that doesn't require you to have an extra payment or go further into debt. But this can be a very risky thing, and it's something I've never really talked about on the channel before, so I want to bring it up now. And what it's called is a home equity agreement. A home equity agreement is an arrangement where a homeowner sells a portion of their equity to an investor in exchange for cash. So the homeowner must pay back that amount within a specific period of time or when the house is sold. So home equity agreements let you leverage the increase in your home's value to help you meet your financial goals, which are usually something like remodeling, putting your kids through college, consolidating debt, all the usual suspects that we typically see people pull equity out of their home for. But this is a little bit different because you don't have to make any payments. It's not like a HELOC or a home equity loan where you're going to have a payment. You're just giving up a portion of your equity to an investor for a price today in exchange for an even bigger chunk down the line in the future. But this is risky because it allows the investor or the investment company to put a lien on your home in exchange for a future percentage of your home's value. You also need to stay current on your property taxes, homeowner's insurance, and any other fees associated with owning your home. And you also may be required to properly maintain the property, just like with a reverse mortgage agreement, which also means that failure to do so may result in paying additional costs at the end of the agreement, as the value of a poorly maintained property and the investor's potential profits could be negatively affected. So it's not like you can have a nice house and do one of these home equity agreements and then just let it all fall apart and say, well, I don't care because I already got some cash out of it. That's not going to work either. So a lot of these home equity agreements have a 10 to 30-year timeline after which the property owner must buy out the investor. So say it's 10 years and you want to keep your house for the full life of your mortgage, say 30 years. Well, you're going to have to pay off that investor in the end in the form of a big balloon payments. You might not have had monthly payments for 10 years, but you are going to have to pay off this investor at the agreed upon time if no sale occurs. So it's not like you get free money forever. One day you will have to pay. But the idea with this is you get this money, which is kind of like a long-term loan against your equity. And then when you sell the house, then the loan is paid off. That's the idea. Most people aren't going to do this and then have to pay back the investor. They're going to sell the house before that timeline is over, and they're going to have the sale of the home pay it off. Now let's go over some of the pros and cons of this. Obviously, one of the pros, the biggest one really, is that there are no monthly payments or interest charges, which is a pretty big advantage over any other type of home loan. There are also very lenient minimum credit score requirements because really people don't care what your credit is. They just want the future equity of your home. And if they determine that you have that, then they'll be able to get their money one way or another because they're placing a lien on your house. So they're not depending on you to pay them back. Ultimately, they're depending on the future appreciation of your home to pay them back. Also, there's no restrictions on how you can use the money most of the time. That's another pro. But let's get into some of the cons. One of the biggest cons is actually the fact that it is a large upfront one-time payment. So it's kind of like winning the lottery in a way, right? You're not taking small withdrawals like with a home equity line of credit or anything like that. You're getting one big lump sum payment, and people who are irresponsible with the money could end up spending it frivolously and kind of pissing away their home equity, so to speak. Also, one of the other cons with this is you really need to pay attention to the appraised value that you're getting in order to receive this loan, because if the home appraisal comes in low, then the investment company will essentially gain a larger percentage of your equity than it should, and the cost to the homeowner are going to be significant when you go to sell and pay this loan off. Also, this can be a very expensive way to borrow against your house because even though there's no interest required, if you see a lot of appreciation in the value of your home, then the investor or the investment company gets a portion of the home's future value, right? So if it appreciates by a lot, then they get an increased amount. So depending on how much the value of your home goes up over the years and how long your home equity agreement is, you could end up paying a significant amount more money than if you were to take out one of these traditional home loan products like a home equity loan or a home equity line of credit. And huge disclaimer, I'm not in favor of any of this stuff. And I forgot to tell you, I'm walking down Hillary Drive in Tiburon, California today. You also have other costs you have to consider, like closing costs, transaction fees, origination fees. These can all add up to several $1,000s for one of these home equity sharing agreements. And you'll need to make a balloon payment, like I mentioned earlier. If you keep the house longer than your agreement is set for, you'll need to have a large amount of cash ready to pay up front. And my guess is anybody who's doing this isn't going to have that cash, so they're likely going to have to borrow even more against their home, assuming that's even possible at that time, in order to pay off the other investor. And if you decide to end the agreement prematurely, you will also be on the hook for paying back the promised amount early. So really, the lesson of the story always remains the same, guys. Really, you should never be borrowing against your house unless it's absolutely necessary. It should be the last resort option for everybody. And if you must do it, make sure you take the least amount of loan necessary to pay whatever you need to pay for, and make sure it's paid back so you don't have a lien on your property or somebody else having a stake in your property. Now, something else I need to go over here is something that was sent to me by Keith, because one thing we've been hearing a lot about over the past few years, and even still to this day, even though inventory on the U.S. housing market has bounced back to what it was pre-pandemic, there is still this big narrative out there going around how there's a big housing shortage. They're talking anywhere between 4 to 7 million houses short still. And in Utah, the state gave a $2 million grant to a nonprofit company called the Utah Workforce Housing Advocacy in order to put out propaganda talking about how there's still a housing shortage in the state of Utah. And I'm going to prove to you that there is no housing shortage in the state of Utah towards the end of this. But first, let's go over what actually happened. The state government gave this nonprofit $2 million to go out there and say that we need to increase the housing supply by changing zoning laws, providing tax incentives, and using surplus public land for housing. And they're even promoting the idea that luxury housing actually helps affordability by increasing overall supply. So essentially, they will say anything to push their agenda. And a lot of people in Utah are really questioning this, like, well, shouldn't that $2 million have gone towards actually building more housing if this is such a problem, and actually gone towards fixing the problem, rather than just have this nonprofit put out all this propaganda telling everybody what needs to happen? You know what I mean? And you're always going to have the problem of NIMBYs, which stands for not in my backyard, because residents in Clinton, Utah, for example, have been fighting more development because of concerns about overcrowding, traffic, and housing density and the mix of housing, like too many condos or single family homes or townhomes clustered together. And I can tell you firsthand, as somebody who lives in an area that is overbuilt and overcrowded in Miami Beach, Florida, it is a real problem, guys. Traffic is the #1 quality of life issue there that really brings me down. I absolutely hate it, and I have to revolve my entire life in Miami around the traffic pattern to ensure that I don't get stuck in it when I go out and shoot these videos. So what's going on here is they are pushing a developer-driven agenda in order for developers to get higher tax credits, higher incentives in order to build more, and basically get subsidized for their business and help them become more successful. And it's more about selling housing rather than educating people. And remember, I told you I was going to prove to you that supply is not actually an issue in Utah. Let's refer to the ReVenture app here and take a look at the for sale inventory in the entire state of Utah. Well, what do you notice? As of right now, there are over 14,000 homes for sale in the state of Utah, which is the highest amount, at least going back to 2017. Even pre-pandemic in 2017, the normal amount of homes for sale in Utah was around 11 or 12,000 homes. Right now, there are over 14,000 homes for sale. And they have the nerve to go out there and tell everybody that there is a housing shortage and that they need to build more, even though there are more homes for sale today than there have been at least in the last 10 years. And at the same time in Utah, the home sales have cratered. You can see that home sales are literally down to 2012 levels right now, which was kind of like when the dust was settling after the GFC and people really were just beginning to start buying again. That's where home sale levels are right now in Utah for the past 3 years in a row. And it's not really getting any better. But that is because of home prices, not because they need to build more. And this home value chart shows you exactly what I mean. Prices in Utah peaked at about $544,000 in about 2022. And right now, today, they're still sitting at about $529,000, slightly lower. So what is the issue? It is home prices. There's plenty of supply, but the prices of these homes are just too high. And then they want these developers to build more luxury housing because it contributes to overall supply. Now, I'm not going to say that real estate is not a game of supply and demand, because it certainly is. And if there was significantly more supply, then that might put more downward pressure on prices, which is the idea behind building more. But you can build as much as you want, but if the prices are not what people can afford, well, ultimately, that's the biggest problem that people face, is affordability. And we know that most developers these days are not building homes that are affordable. They've started to. Over the past year, they've really been shifting their strategies and building smaller homes at more affordable price points to meet buyers where they're at financially. But that's only a new trend that's just begun. So Utah is running into a similar problem that a lot of other places across the country are, where there is no supply shortage. There is just a shortage of affordable homes for sale. A lot of these homes that are sitting on the market are priced at completely clueless levels, far above and beyond what people actually can afford to pay. And home sellers are only just now starting to realize that, going back to the beginning of this video with days on market starting to exceed pre-pandemic levels throughout most of the country right now. As that continues to happen, more sellers are going to have to get with the program and lower the price of these homes in order to actually get them sold. So let me know what you guys think about all this in the comments below. And if you enjoyed this video, make sure you subscribe to the channel. And if you don't want to wait for my next video to come out, check out this one on the screen right over here, and I'll see you in the next one.